And here is a look at where markets ended the shortened trading week as we begin a notoriously bad month for stocks. This after we got the pivotal August jobs report, as we mentioned earlier, showing much fewer jobs added than expected, while the unemployment rate remained in line. We also got revisions for July showing 25,000 fewer jobs added last month than what was originally reported. Only 89,000 were added. That is the lowest amount since December 2020. This is the last jobs report before the Federal Reserve meeting later this month. Joining me now with more on what this means for the markets, Piper Sandler Chief Investment Strategist Michael Kantrowitz. And this report again showed not just a weaker than expected number, but now we have all of these months of revisions. The only month that we didn't get revisions to the downside was February and March. Yeah. And we may see revisions for the number that we got on Friday.
Very likely. We really have to take some of the employment data with a grain of salt until we get those revisions. So the prior 2 months revisions combined were negative 89,000. So that certainly takes some of the excitement off of what we had gotten 2 months prior. So this report, I'd say, was a continued trend of softness underneath the surface, while the unemployment rate declined to 4.2. The establishment payroll data under the surface, again, I'd say were fairly weaker. We look at cyclical employment, so we exclude education and healthcare, and we remove the birth-death model, which has been a big piece of debate around how it's been overstating employment. That's now firmly negative at about negative 60,000. So, you go into recessions, the economy goes into a contraction because of cyclical activity. So when you strip out education and healthcare, we have negative payrolls.
Which is where the biggest, so look at this at the screen, that is the biggest jump, the 47,000 for the two that you're saying you're removing from your consideration. The other issue, too, is that, we had the surprising number with ADP, the weaker ADP report. JOLTS. That is showing another recessionary signal. I wouldn't say recession, but at the same time, this does lead to that weakening economy story that the Fed's going to have to consider. And this is the last report before they meet for their September meeting and make their decision. What are you saying now, and what is your prediction now for that?
So we've been bullish on equities, just to bring it back to markets for a second.
Sure.
Most of basically from October of last year, when markets sold off on the fear of higher rates. And so we turned bullish because we didn't think rates were going to continue to go up. We didn't think the Fed was going to hike anymore. And we thought we had this view we called softy locks, which was moderating economic data and moderating inflation. So there's a period, historically it happens, we've seen this the last 2 years, when bad news is good. That's always the case when we have an inflation problem or fear around that. And for much of this year, the softer data we've gotten for much of this year has been good for equities. I'd say that's over as of July. That ended because inflation is not a concern amongst investors anymore, nor should it be, with the unemployment rate up and the data we're seeing in employment data. That's why the Fed has shifted, recognizing their mandate is far more balanced, with inflation no longer really a risk and unemployment a budding risk or employment softening. So I think the market's going to continue to waffle around and react to the data in terms of what we expect to see in terms of the Fed. But I think this report pushes us closer to 50, but not a slam dunk.
Well, so then what is your outlook for markets for the rest of the year? So there's 3 Fed meetings to go. We've got September, November, December. But besides the Fed, does this change how you approach investments or strategies for the market?
So in the the July payrolls report, so a month ago, we turned neutral on equities, which, I know oftentimes analysts are really bullish or really bearish. I don't see a high conviction rationale for either of those right now. I'm no longer bullish because I don't think there's any more inflation fear or good news from lower interest rates or bad economic news. And I'm not quite bearish yet because I don't think the economy's collapsing. I think we're going to continue to moderate at this pace that we've seen. We don't have any major macro negative impulses. Oil's not spiking. Inflation or interest rates are certainly not spiking. So the lagged effect of Fed policy, which many have debated, is not really that powerful. I think part of that has to go to the point that there's been a lot of, obviously, federal spending. Oil prices haven't been high in 2 years. So the impact of interest rates is kind of taking its time on weighing in the economy, not causing it to collapse. So I think that's going to continue. So I don't think you want to be so negative yet.
Okay, good.
But
good.
Continue to focus. No,
we want to hear that. We want to hear that.
But the idea that the market's going to broaden out and go up a lot from here, I think is very unlikely. And so with the Fed in our back pocket, I think investors will continue to believe that as long as we get data like this payrolls report, the Fed will have our back. That's not bearish. That's not super bullish. It's just kind of, okay, we can kind of stay here.
We'll take that takes us to just kind of an easy feeling about the next month anyway, because September can be a worrisome month for the markets. All right. Michael Kantrowitz, it's great to see you.
Okay.
Thank you for being here on set with us. We appreciate it.